In this session we shall be taking our first look at bonds. James Bond? No, this is different. When a corporation wishes to raise money, it has a number of options. We have already introduced borrowing from the bank and the issue of stock. Bonds are another way to raise money. An issue of bonds is like asking a lot of folks to give you money and then you give them a series of IOU notes. The difference here is that those who lend you money are looking to get their money back with interest. How much interest they get will depend on how much is being offered. If too little interest is offered, then investors will look elsewhere and find opportunities where the return is better. If the figure offered is too high, then the corporation will struggle to generate the profit required to be able to pay the money back that they have borrowed. The corporation will offer different types of bond to attract different investors. Different types of bond then. What about the investor who does not want to take a great risk, but who is looking for a better return than simply putting money in a savings account or investing in shares? The best issues for such an investor would be bonds that are tied or linked in some way to the assets of the corporation as a security. That way, the sum of money loaned as a bond is being secured in the event of any poor performance by the corporation. In the event of the corporation being declared bankrupt, the bondholder's claim comes before that of investors holding common stock. An investor seeking a better return would need to consider the size of the risk to be taken. An unsecured bond is likely to be offered with a higher interest rate, but the lack of security means that the risk of losing the money is greater. Buying a bond issue from some companies will be more attractive than buying from a company that has been performing poorly recently. At one time, the dot-com companies were seen as attractive investments. Investors might be less likely to flock to take up an unsecured bond issue with such a company now. Corporations might offer a bond issue that is an even greater risk. These are bonds that can be converted to stock. An investor needs to understand clearly what the risk is that is involved here. The corporation also needs to understand the risk of raising money in this way. In some bond issues, a corporation might have an agreement or condition that it can repay the bond at any time. This can have an advantage to the corporation. If it does well, then the liability can be removed prior to the maturity date and less interest is paid out on the bond. Of course, this lessens the attraction for the investor seeking a longer-term return. A bond that can be terminated by repayment in this way is referred to as a callable bond. Of course, there are some bonds we're not interested in. Let us consider convertible bonds more closely, since these were quite popular at one time. Now they are seen as more of a risk, and it is important to understand how this has come about. If all goes well and the price of stock keeps rising, then the return to be expected can be much greater than putting one's dollars into other types of bond issue. This was particularly the case in the 1990s, when an increasing number of such bonds were issued. Such an attraction led many corporations to issue this type of bond with a lower rate of interest. And for the board of directors, it seemed rather rosy. As long as things went well, it was to be taken up. This had a particular advantage in that it meant that the money borrowed was not going to have to be repaid in cash. Then a change occurred, and the situation changed both for the corporation and for the investor. As the stock markets fell rapidly, so did the value of the bond option to convert. That meant the investor was receiving a low rate of interest and an option that was losing value rapidly. Under these circumstances, those investors who could do so chose to ask for the return on their investment, whilst others were doing the same as soon as the bond reached the maturity date. For the corporation, the situation was even more precarious. Corporations whose planning included an element that assumed a part of the issue would not have to be repaid in cash were under pressure. Some had to borrow further to repay the issue, often at higher interest rates than those originally offered on the bond issue.